Hello, everyone. Stop what you're doing for a second because something just happened in the silver market that most people won't fully grasp until the consequences are already baked in. Over the last few weeks, nearly 100 million ounces of silver have been stood for delivery on a major futures exchange. Not traded, not rolled, not paper shuffled. Delivered, taken, removed. And when that much metal gets pulled out of the paper system that quickly, it stops being a normal market event and starts looking like a signal, a message sent in ounces instead of words. In this script, I'm going to break down exactly what happened, why it matters, who might be behind it, and what it could mean for smaller silver investors, people who don't get private briefings, who don't have a seat at the big table, and who usually find out late. We're going to talk about delivery numbers, the quiet policy shifts that change the rules without making headlines, the tug of war between industrial demand and financial demand, and why a strong dollar might be one of the biggest optical illusions in modern finance. Then, once we connect the dots, I will show you the one pressure point that could force a repricing event so obvious that the mainstream can ignore it. Because if you think this story ends with a few big deliveries, wait until you see what happens when real-world buyers collide with paper promises. Now, quick note before we dive in. My stats show a huge percentage of you watch these videos, but you not subscribed. If you value straight talk instead of recycled narratives, hit subscribe and comment OG John AG to support original creators and not the copycats. And if you want daily updates, fast breakdowns, and voice notes when something moves, stuff I don't have to always put on YouTube, I've got a WhatsApp channel and community linked in the description. Join it so you're not reacting late. All right, let's jump in. Here is the first thing you need to understand. Most people think silver is a price chart. Up today, down tomorrow, maybe a little hype, maybe a little fear. But the real silver market isn't the chart. The real silver market is the flow of physical ounces, metal moving from sellers to buyers. And the moment major players stop playing the paper game and start demanding delivery, the illusion gets stressed because futures markets are built on a simple reality. Most contracts don't end in delivery. They get rolled forward, closed out, netted, offset. That's normal. That's the engine. The system runs smoothly because most participants treat it like a financial casino, chips in, chips out, without ever asking for the physical gold or silver behind the chips. But when big money shows up and says, no, I don't want paper, I want metal, it's like walking into a bank and saying, I want cash. Real cash. A lot of it. While everyone else is still swiping plastic and assuming the ATM will always work. And the numbers we're seeing are not normal. One recent major delivery month saw close to 70 million ounces stood for delivery. Then, this is the part that should make your eyebrows go up. During what supposed to be a quieter, non-major honey month, the market still saw tens of millions more within days, within a week. Minor months are supposed to be the months when the system breathes. Instead, it looks like someone is pulling oxygen out of the room. So the next question becomes the one that turns this from interesting into explosive. Who is taking the metal? Because retail stackers, even motivated ones, do not stand for delivery of 38 million ounces in a week. That's not a couple of guys buying tubes of Eagles. That's not even a big coin dealer restocking inventory. That's institution level, that's government level, that's mega industrial level, or it's multiple major players moving in parallel. And when you ask who would want that much silver right now and why, the list gets short and uncomfortable. Maybe it's a government, maybe it's an industrial giant, maybe it's a consortium, maybe it ranks someone who knows something about future supply constraints that the public want to understand until shelves are empty. Or scarier, it's not one buyer. It's multiple informed buyers reacting to the same signals at the same time. Because in markets like this, you don't always witness one mastermind. Sometimes you're watching a stampede of informed players repositioning before the story becomes mainstream. Now here's what the mainstream financial media will do. They all whisper about rebalancing, technical flows, normal volatility. They'll talk about a chart pattern. They'll talk about speculative mania. They'll warn you to take profits before you lose it all. But they won't focus on the one metric that matters most. Who is removing the metal? Because that conversation leads to the question they don't want to touch. What happens if the exchange can't meet delivery demand at the pace buyers are demanding? I'm not saying the system collapses tomorrow. I am saying the system becomes vulnerable when it asks forced to do the one thing it's designed to minimize, deliver. And to understand why, you need to understand rehypothecation. Rehypothecation is a fancy word for a simple problem. The same underlying asset gets promised multiple times. Imagine a landlord renting the same parking space to 5 different drivers, because he assumes most of them show up at the same time. It works until it doesn't. In paper silver markets, the same ounce can be represented by layers of claims, futures contracts, ETFs, synthetic products, swaps, options. That structure creates the appearance of abundance. It creates volume. It creates liquidity. It creates fees. It creates an ecosystem where people trade silver without ever touching silver. But the weakness is obvious. If too many people demand the metal at once, the paper promises get exposed. That's why the best comparison isn't a normal market. It's a redemption event, like a fund that promises daily liquidity while holding illiquid assets. It's fine while everyone is calm, but when people rush to redeem, you find out what's real and what's just accounting. And in silver, physical demand is the redemption test, so why now? This delivery behavior isn't coming out of nowhere. It's showing up alongside a series of quiet supply chain shifts and policy moves that change the landscape without making headlines. Silver has increasingly been flagged as a critical material, not because it's shiny, not because it's a collector's item, because it's essential. Electronics, solar, military systems, and the industrial backbone modern nations run on. Once a material gets treated as critical, it stops being viewed as just another commodity and starts being treated like a strategic input. That's a different mindset. That's the mindset where governments think in stockpiles, domestic needs, and supply security. And while the public debates whether silver is too volatile, the biggest players ask a different question. Can we secure what we need before everyone else does? Now layer on the reality that a massive share of refining capacity is concentrated in a small number of hands. When major refining hubs tighten export rules or prioritize domestic needs, the global supply people talk about becomes not global very quickly. And here is the part people don't like admitting. When a country refines a huge portion of the world as silver, they don't need to ban you from buying it. They just need to slow the faucet. A small policy change can create a big downstream shortage. So when you see massive delivery demands on an exchange at the same time, you see policy signals shifting toward domestic prioritization. Donati call it random. Recognize it as a pattern. Because silver that exists somewhere is not the same thing as silver that is available, deliverable, and accessible to global industry on a specific timeline. That's the difference between the warehouse and the shelf. Now let's make the scale less abstract. A monster box of silver coins is heavy. Multiply that by thousands, multiply it by tens of thousands. Now you're talking about logistics, security, warehousing, and planning. Nobody does that casually, which is why we have to ask, uncomfortably but honestly, could a government be involved? I'm not telling you it is. I'm telling you the behavior matches what it would look like if a government or government-linked institution was quietly building or replenishing a strategic stockpile. And before someone says, why would they do it in the open market? Remember, standing for delivery is legal. It's how the system is designed. If you have the capital and you want the metal, you can do it. And if you're connected, you might prefer mechanisms that look normal on paper even when the scale is extraordinary. Now, industrial giants matter too, because industrial silver demand is not a theory. It's not a maybe. It's a pipeline of real usage that keeps expanding. When a company that depends on silver begins securing supply directly, it's not because they want to speculate. It's because they fear disruption. We have seen the blueprint. Instead of buying on the open market and hoping supply is there, major buyers go directly to producers, lock up supply, buy door or concentrate, pay up, secure feedstock, send it through preferred channels, and reduce middleman risk. That is not what buyers do when they think silver will be plentiful forever. That's what they do when they think the next shortage could become a national problem. And here's where it gets spicy. When industrial buyers start to worry, they don't buy a little more. They front load, they stockpile, they think, if I need this for the next 5 years and I'm not sure it will be there, I'd rather hold too much than too little. Because running out of silver isn't like running out of paper clips. It can shut down production lines, it can break contracts, it can turn into a reputational disaster. So look at the battlefield forming. One side, industrial demand that's non-negotiable. They need silver to operate. Another side, investors seeking exposure, anticipating repricing. Another side, governments treating silver as strategic. And then retail, almost always last, paying the highest premiums, fighting for scraps. That's not drama. That's how commodity cycles work. Easy supply gets spoken for before the public understands what's happening. And here's one of the most overlooked facts about silver. A surprisingly small portion comes from primary silver mines. A huge share is byproduct from mining other metals. That matters because byproduct supply does not respond quickly to silver's price. If silver doubles, copper miners don't instantly double copper production just to get more byproduct silver. So the supply curve is rigid. When demand rises and supply is rigid, the pressure doesn't release gently. It builds, and then it snaps into a new price regime. Now, let's talk about price. Silver has moved fast. And whenever silver moves fast, people start screaming, bubble, blow off top. This can't last. But there's a difference between a bubble and a repricing event. A bubble is driven by pure speculation and collapses when belief collapses. A repricing event happens when the underlying reality changes. Scarcity, industrial pull, policy restriction, supply deficits, and the old price no longer matches the new structure. When you have consistent deficits, physical supply being removed and access tightening, that's not a bubble narrative. That's a scarcity narrative. And scarcity narratives get real fast. Now I want to pause and say something simple. Small investors make a big mistake when they focus on price action and ignore ownership behavior. Price is the public scoreboard. Ownership is the private strategy. And right now, ownership behavior is screaming. If the biggest players on earth are moving billions into physical silver acquisition month after month, the correct question is not, what does Jim Cramer think? The correct question is, what do they know that you don't? Maybe they know future demand is bigger than people think. Maybe they know supply disruptions are coming. Maybe they know refining bottlenecks are worse than reported. Maybe they know policy language is about to tighten. Maybe they know hidden short exposure exists that becomes unmanageable when delivery pressure continues. Or maybe they simply understand that in a world where currencies lose purchasing power, hard assets become lifeboats, which takes us to the dollar. People love saying the dollar is strong because the dollar index is up. But the ES like saying someone is healthy because they were taller than the sickest people in the room. The dollar index measures the dollar against other fiat currencies that are also being devalued. It's not a true measure of purchasing power. A better measure is, what can your dollars buy? And when you measure against hard assets like gold and silver, the story changes. Assets priced in dollars look like they're going up, but assets priced in gold often look like they coming down because the currency is the unit that's melting. So when you hear silver is going up, a smarter framing is often the dollar is going down and silver is reflecting that reality. Now let's make this practical for the person watching who's thinking, okay, what does this mean for me? It means you can't outbid governments, you can't outmuscle industrial giants, you can't outleverage hedge funds, but you can pay attention early. You can understand the difference between paper narratives and physical signals. You can stop letting mainstream headlines scare you out of positions at the exact moments physical accumulation is accelerating. You can think like a risk manager, not like a gambler. And you can avoid the trap that kills most people, waiting for confirmation from outlets that ignored the signal until it was obvious. Because once mainstream media starts screaming about silver, it won't be because it's safe. It'll be because it's obvious. And when it becomes obvious, it becomes expensive. Now drop a quick win in the comments. Something you've done well financially or personally. Not a flex, a real story. It lifts the community. And answer this too. Who do you think is the biggest silver buyer right now? Government, industrial, or financial? Now let's talk plumbing, because this is where most people get lost and then fall into emotional decisions. On the exchange, inventory isn't just one pile. There's metal that's registered, ready for delivery. And there is metal that's eligible, stored but not committed unless an owner chooses to make it available. Think shelf versus warehouse. When delivery requests surge, the shelf empties first. Then the system has to coax metal from the warehouse to the shelf. That's where stress starts, not because silver doesn't exist somewhere, but because deliverable silver at a specific place on a specific timeline is a different question. That's a timing problem. And timing problems are what break paper systems, because paper systems are built on confidence that settlement will happen smoothly. They can look fine for years and wobble in a single week if too many participants demand the underlying asset at the same time. That's why delivery pressure matters more than price action. Price can be pushed around with leverage, headlines, and risk-on, risk-off narratives. Delivery forces reality. Now here a thought that should sit with you. What if these buyers aren't only chasing profit, they're chasing insurance? If a buyer's goal is insurance, a $5 dip doesn't scare them. It motivates them. They don't care about next Friday's candle. They care about securing metal before access tightens. That's what strategic accumulation looks like, persistent calendar-agnostic buying. Now bring in deficits. A structural deficit means the world consumes more silver than it produces year after year. That can be masked by above-ground inventory for a while, but every deficit year drains the cushion. The thinner the cushion gets, the more sensitive the market becomes to shocks, a mine disruption, a refinery bottleneck, a policy change, a surge in industrial demand. Silver is uniquely vulnerable because so much supply is byproduct. If base metal mining slows, silver output can fall even if silver demand rises. That flanks the kind of feedback loop that turns tight into scarce without warning. If you want a street-level truth signal that doesn't require a Bloomberg terminal, watch physical availability and premiums. Paper price can look calm while the real market is straining. because premiums reflect replacement cost and real-world tightness. And this is why critical material language matters. Once a commodity becomes strategic, countries don't just buy it, they protect it. They prioritize domestic use. They tighten exports. They shift from sell to the world to secure for ourselves. That's not a conspiracy. That's what nations do. Now, retail is almost always last. Not because retail is dumb, but because retail is fed the story late. When price rises, they're told it's too late. When price drops, they're told it's going to zero. When real signals show up, they're distracted with noise. If you want to break that cycle, follow flows, not feelings. Deliveries are flow. Direct mine sourcing is flow. Export tightening is flow. And the flow right now points one direction: physical control. Now let's talk about the battle scenario, because this is where things can get violent. Industrial buyers can delay purchases for a bit, but they can't stop needing silver. They can't redesign the global electronics stack overnight. They can't rebuild the solar pipeline without it. So when industrial procurement collides with persistent investment demand, you don't get a polite market. You get a bidding war. And bidding wars don't care about anyone's comfort zone. They care about clearing price. Picture it like this. One major manufacturer decides to secure a year of feedstock just in case. That drains supply. Another manufacturer notices and does the same. Then the sector begins front-running itself because nobody wants to be the last buyer in a tight market. At the same time, funds chase performance. Then retail piles in when the story becomes obvious. That sequence rarely ends with gentle corrections. It ends with repricing. Oh gee, it matters more than you think.